in the market. It is interesting as usual. I am so excited to be joined here by the CEO of A2 Gold, Peter Giannoulis. This is a pleasure to have you on. We did a space earlier this week and we were talking about gold. And you know what? I think we were right with everything that we said in there. And the story has continued to move. Gold has been a safe haven even throughout all of the volatility in the market. Another 2% up today. We've crossed through 42.50 on gold futures like a rocket ship. Peter, welcome to the show.
Hi, Gab. Thanks for having me on.
Yeah, my pleasure. I will say, as we get started here, I really want to be able to talk ticker specific as we get into it. So I am going to read a quick disclosure for the audience before we go into this. That way, everybody is fully aware with these pieces. So real quick, this advertisement for AUAU is a paid advertisement. It is intended for informational purposes only. It is not a recommendation or endorsement of any specific stock or investment strategy. Investing in stocks involves risk, including the possibility of losing your principal. Always conduct thorough research before investing. With that being said, let's go ahead and get into things. So Peter, coming out of our discussion, I've done so much more research. I've been deep diving into not just gold, but the miners. I had a great live stream earlier this week. I gave you a shout out on it that I did with Peter Schiff, and we talked a lot more about gold. And he's really convinced that, it's not 5,000, it's not 10,000, it's maybe 100,000 that we're going to. He echoed your sentiment that this is extremely bullish for gold miners and exploration firms who, because their cost stays the same as the price of gold rises, they see exponential returns. And I'm just becoming more of a gold bug these days. So let's talk about it. If you could start off with giving people a little bit of your background so they can understand your expertise in this area, then we'll take it from there.
Yeah, sure. Absolutely. I started in the industry in the late 90s. I was part of a well-known investment bank called Salomon Brothers at that time. Went through a few mergers with Citi and Travelers, but emerged from there working at the Salomon Brothers Hedge Fund Group from 1996 to 2005, where our group spun out of Citigroup and then created a new fund. I took that opportunity to create my own fund called Carrollton Asset Management, which primarily focused in the junior mining and junior exploration industry. So I would say that most of my expertise is with respect to precious metals, uranium, and other type of energy metals. But we've also, in the fund, had also invested significantly in oil and gas and other types of other resources. But I would say that precious metals was by far away the largest investment theme that we invested in for the last 25 years. And then in 2019, I took over a project generator in the Western United States called Legion Gold, and shaped that company into the image that I thought most exploration companies and junior mining companies should be. And over the last 6 years, we've transformed this company from a 3 million market cap company to over 100 million market cap company, and we've done it while minimizing dilution. And over those 6 years, I'm proud to say one of the better performing companies out in the industry in our peer group. And I think we've done it the right way, is what I would like to think, by prioritizing shareholder value and appreciation rather than just market cap. So yes, our market cap has increased significantly, but our share price has also increased significantly. Because as you remember, there's two ways to get a larger market cap. One is just by printing as many shares as you want. In our case, we've been able to control the dilution and also increase value to shareholders. So a lot of, I believe over the last 25, 30 years, I've been involved in on different aspects of that, not only on the buy side, but also on the sell side, and then on management and being on the board of directors. So I've kind of seen all facets with respect to the industry, being on the management side and then also on the investment side, both on the buy and the sell side. So that's just a brief background. Over that period of time, from the investment side, I've had 5, 6, 7 successful exits over a very, very difficult period of time, because really the last bull market in the junior mining industry, in my opinion, ended in 2007. So it's been about 18 years. And I do believe now, and the people who know me know that I haven't been as optimistic as I have been recently. And I do believe we're in the beginning stage of a major, major, major bull market, not in gold, not in the miners, but actually in the exploration industry companies.
Sorry, I know I was muted there.
Okay.
I'm glad you hit on that. I wanted to really dig into this to give people a deeper understanding of the different segments of investing in gold. So, right. So everybody can look at it and say, hey, GLD, right? It's kind of like the classic. It's up 61.5% this year, right? It mimics if somebody was looking at gold futures, which holy cow, just crossed 4,300, by the way, today. Just absolutely wild. And, that right now is up 63% year to date. So, hey, you can get very similar exposure right there utilizing that, but there's depth to this industry, right? There's mining, there's exploration. So can you just kind of break down the different segments and really honing in on exploration and why this segment specifically? I mean, your stock, right, is up almost 700% year to date compared to gold being up 63%. So clearly there's differences in the risk and return and the segments here.
Yeah, from an investment perspective, I start with owning physical gold, and physical gold means you need to take storage and you need to take physical control of it, and then worry about storage. And then going there, you have what are paper instruments, which are the GLD or some other type of derivative instrument to mimic the price of gold. So you're having a direct exposure to gold. And then after that, then you get down into the senior miners. So the Kinross, the Barrick, the Newmont Mining, the Anglo, the Agnico Golds of the world. There's 5, 6, 7 of them, which I would consider majors. And those, produce anywhere between 2.5 to 6 million ounces of gold per year. And the operational leverage to the price of gold is a little bit, it's clearly higher than gold, just the change of gold prices, but it's going to be fairly muted. And those companies have done very, very well over the past 5 years. And then moving down below that, you have what are called mid-majors. They're producers or junior producers. They're companies that produce anywhere between 100,000 ounces all the way up to 1 million ounces. There's a few of those 15, 20 companies that are in the universe. And those have a lot more operational leverage to the change of the price of gold, both positively and negatively. And those about 2 years ago started taking off. And I don't believe they've caught up to the price of gold yet, but they still have a lot of room to run. But those companies are the producers in this sector. And those are, I would say, some of the metrics that are important, not only of the price of gold, but they're all in sustainable costs, so their cost structure and the types of mining, whether that's open pit or underground mining, the jurisdiction. So there's a few risks and there are different ways to value these companies. But they are producing companies that do have cash flow. And then you get to what I consider the highest operational leverage, or the highest leverage to the price of gold, which would be the explorers. I consider those land banks. I consider those companies should be valued at what they have in inferred and resources in the ground. And those companies have significant more leverage to the price of gold. And those companies have really underperformed in this entire gold bull market from 1,700 all the way to 3,000 or 2,800. And then have recently, as you've seen the price of A2 gold, but other companies have also participated, go up 3, 4, 5, 600%. Now, I believe that we're just approaching a valuation closer to 25 to 2,800, and we still haven't participated. There's still this room that goes from 2,800, in my opinion, 2,800 all the way to, I just saw gold cross 4,300 on the spot market. So there's that huge potential. Because the way these companies are valued are how much gold do they have in ground, what's the fixed cost, and then what's the operating or the cash cost to take that gold out of the ground, and usually those are fixed costs. So when gold prices go up or go down, it has a material, a large effect in the valuation of these companies. And these companies, in my opinion, continue to be really cheap relative to the price of spot gold. So there are other derivatives of what I've tried to simplify it, but those are what I believe is just a quick 10,000 meter, 30,000 foot view of the gold market and investing in that. You have the ETFs, and then you have direct exposure into companies. So the GDXJ and the GDX are. The GDX is essentially a senior index of gold miners. The GDXJ historically was the junior index, but they're no longer juniors. They're all producers, and they tend to be mid-majors to even large cap companies in there. But if you really want to get exposure to explorers, there's no ETF. You really have to do your due diligence and get involved directly in these companies. And the potential returns are dramatic and outsized beyond anything that most people can expect. I would say this industry suffered for 5 years, and then in the last 8 months, it's up 500, 600%, and probably could do the same thing over the next 12 months if gold stays, if stays at these levels. So because they really have not caught up to the price of gold. Gold has moved up significantly.
Yeah. Gold, obviously, like you said, heavily moved. People can see gold futures right here. It's interesting. We had a period basically from 2011 until 2023 where there really wasn't any movement, right? We peaked up here. We went down to 1300. We didn't really break 2K. And then you break 2K and still not a ton. And then basically from February of 2024, where we break 2K, I mean, you have a double from there. And so it's essentially in 18 months, right? It just starts absolutely going nuclear to the upside. And then what you were saying, right, where, we could take a look at A2 Gold on that time frame, right? So it's just sitting there, throughout those years, and then sitting there. And then even when in February of 2024, gold starts taking off, you're still trading down here, and then boom, like a rocket ship. And now you've crossed above $1 at this point, and stocks have 672% on the year, 460% last 52 weeks. So it really, like you're saying, is truly kicking in now. Is there what's your thought? I guess two questions. One, what's your thought process as to why it kind of had that delayed move upwards in the exploration side of things? And then two, off the back of that, maybe you can talk to us a little bit more about the business model of an exploration firm and how people should be evaluating it and doing their research into it.
Yeah. So the first part of the question, I have an opinion. No one really knows with certainty, but I believe that gold investors wait to see how sticky is the price of gold before they go back and value companies. So most companies that I evaluate or I look at, including A2 Gold, are using, when they evaluate their projects, are still using 2,500 gold. No one that I've ever seen right now in the last month is using 3,000 gold or 3,200 gold. So they evaluate your projects based on 2,500 gold, and gold's at 4,300 right now, which something I have never seen, meaning that gap between what you're valuing your project based on the price and what the current spot price of gold is. So I think what the market is still waiting for is a correction in gold back down to 3,400. And then that will reset the new valuation metric for 3,200. And then gold will probably continue. I'm sure if you ask Peter Schiff, will continue all the way down to all the way up to 5,000 or 6,000. But historically, at least in the 30 years that I've kind of been in this industry, it's an ebb and flow. So the gold price goes up. The valuation metric for your projects goes up slower. Gold corrects, but you don't correct that metric. So it gets closer, then gold goes back up, and you start this whole process. So I think that that's why there's always this delayed effect in the valuation of the explorers. But that's the opportunity. Even if you were to have a correction down to 3,200, it's still not reflected in the price because people are still using $2,500, $2,600. And I talk to the majors quite frequently, and one of them is a major investor, and no pun intended, a major investor in our company, Kinross. Yeah. And they I know what they use as a valuation metric for projects. And just until about 5 months ago, they were using 2,200 gold, right? So there is that delayed effect. And once they adjust to 3,000, 3,200, 3,400, I believe you're going to see major stepping up in acquiring a lot of the juniors, because it'll take them 3 to 5 years to get where the junior is at in terms of exploration, and time is money. So what they will do is they'll take over some of the better juniors and then accelerate the exploration to get it into a mining decision. So that's the first thing. On the second part of the question was about the metrics that we use to value. I think I'm kind of mixing.
Yeah. Just understanding the business model and, how an investor, like the company's 110 million market cap now, right? Like, how is somebody analyzing this?
Yeah. So I think there's a metric that I've always used, which is the percent of the spot price of gold to value a company. Some people have always said, well, we use $50 an ounce for an inferred resource, or 30 or 20. That's really, I've never believed in that metric, because if gold's $500 an ounce, $50 an ounce to value your resource is 10% of the spot price of gold. That would be on the high end from a historical perspective. But $50 an ounce when gold's 4,300 is also equally absurd because it's only about 1.2% or 1.3% of the value of the spot price. When the historical average has been between 3 and 4% historically over long cycles, but in bull markets, it can be 7 to 10% of the spot price. So to start off with that metric is what's the value of your resource. So when I look at it, when I take off my A2 gold hat and I put on my investor hat, as I did for 25 years, I look at where's their resource, where's their asset located. So jurisdiction for me is not always the most important thing, but over the last 10 years for me, and I've been on different interviews, and you can verify this, but I've been saying jurisdiction is probably the single biggest decision that I would make in terms of investing. So are you in a safe jurisdiction, meaning you can have the best asset, but if they confiscate it from you, you have nothing. So a jurisdiction would be number one. The second is what type of mineral. So in this case, we do gold and silver. And third would be what type of resource do you have? I historically only look at companies that actually have a published resource, or what is called the 43-101. I rarely have ever dipped into companies that are purely exploration companies looking for gold. You need to have an economic resource, or at least a resource published where I can validate I have 1 million ounces, 500,000 ounces, 300,000, 3 million ounces of gold, and I can read that report so I can look at the technical qualifications of that actual resource. So that's how I kind of look at things. And then I apply that valuation metric that I talked about earlier of that 3, 4, 5, 6, 7% of the spot price of gold. So if you look at it, we have 1.5 million ounces. If we were, and I'm just using theoretical numbers here, if I were to value the asset at 3 to 5% of the spot price of gold, that would make it 120 to 150 US dollars per ounce. That would give you, this is a top level way of valuing these companies, and there's other ways to do it, but that would give you a 250 to 300 million dollar US dollar valuation. At what we have today, Canadian would be 400 million, and then you can divide how many shares we have outstanding to come out with, what potentially the value could be. That's from a top-down perspective. On a bottom-up perspective, what you can do is just to basically a NAV analysis, look at what's the value of the gold in ground, how much are you going to recover of that, what's your cost to recover that, and what's the fixed cost, and then you add other types of costs, and then you discount that, whether that's by 5, 7, or 10%, depending on the stage, and you come out with a value. What I have seen over many of this analysis is that doing it top down or bottom up, you almost come at the same numbers roughly. And just to finalize the bottom up, let's say that the NAV with a 7% discount of our project is 1.5 billion.
Yeah. Then
the other metric would be, the other variable you need to employ would be a price to NAV. So historically, exploration companies, depending on the stage, will go between 0.2 and 0.3 to 0.4 of the price of the NAV. So 0.2 of 1.5 billion would be 300 million US, which is 400 million Canadian. And you see, you kind of get at almost the same number, different ways of reaching it, but you essentially get at the same numbers. And I'm using these numbers loosely. This is, don't take this as a way of valuing. I think you need to do your own valuation metric, but I'm giving you my experience, 25 years of how I used to value these companies. I think the exploration companies relative to the price of gold are by far the cheapest I've seen it. And this is after a massive run. They're still historically very, very cheap.
Yeah, it's super interesting. I have a lot more that I want to discuss kind of in the general world of gold, but I do want to lock in on A2 for a few minutes here before we go a little bit more broad. A couple of things here that I think are important. You've already mentioned it, but institutional investors are starting to actually allocate to gold. And I think that this is pretty big. And I lightly discussed it with you on the call the other night that Morgan Stanley issued a note encouraging a 60-20-20 portfolio with 20% towards gold. Even Peter Schiff thought that was aggressive.
Yeah, I think it's aggressive.
But hey, they're starting to move that way. And I think that they're doing it because they see global reserves moving up, right, in percentage of, gold to dollar. And the big thing about the mining industry is that, and maybe you can talk to this, the mining industry has made almost no new discoveries over the past 10 years as exploration was essentially cut to the bone, right?
Yeah, I mean, most major companies basically gutted their exploration departments 20, 30 years ago, and they have not built it up. Now, the way the majors have decided to invest in exploration is by investing through the juniors. But even those levels are significantly below what they were investing when they had their own internal exploration department. So what I consider major discoveries have been made over the past 10 years that I can think of, 10 or 15 years. And that is a direct result of not having spent the dollars to actually explore. And that will come home to roost. It's coming home to roost now as companies are ramping up their production, but they're just ramping up production. They're trying to front load their mining operations so they can take advantage of 4,200 gold, but they're just depleting their reserves and resources at a faster pace. This is another reason why I favor exploration over production. Now, 5 years ago, I absolutely favored production. It was very cheap. But today, if I'm an investor and I want to get involved in the gold mining exploration industry, I would allocate to a few of these explorers who have a resource, a published resource, as I discussed, and that you can kind of come up with your own valuation metric. And you will find they're still very, very cheap. So I believe the way to go is through the exploration side, and A2 Gold is one of the companies in one of the safest and probably best jurisdiction in the world. We have a very large asset. We're continuing to explore for that and grow our resource, which is approximately 1.5 million ounces of gold, 9 million ounces of silver. We haven't published an updated resource in over 4 years. And that's
why is that?
1,700. Well, we were in a bear market, and there was no incentive to go in and spend a lot of money doing work. And now that the market is going to recognize that and give you credit for expanding your resource. Now the whole paradigm has shifted. Now, from being an extremely conservative exploration fund, which we were an exploration company for the last 4 years, we now are switching to a very aggressive stance. We're well financed. We have significant amount of capital in the bank, as well as potentially drawing on the warrants, which are deep in the money. So we have access to a lot of capital. We have a great, probably there's a few other companies that have this, but we have one of the best shareholder rosters out there. And besides not only Kinross, Eric Sprott, and some other legendary type of and big investors that have put their faith in our company. So we're very well positioned, and we're hopeful that we can take advantage of this and make the right decisions. And that's what we're trying to do.
In those safe jurisdictions, you can really command a premium with that, right?
Absolutely. I spent a lot of my career in Latin America, actually, and I always made a joke that about Latin America. Mexico doesn't apply to this, but I'm talking about South America more than Latin America. That if you have a bad asset, you lose your money. If you have a great asset, you lose your money, because they'll figure a way how to confiscate it from you. So it's always mediocre that does well there. In North America, and this applies to certain jurisdictions, but primarily Nevada being the best in the U.S. And there's other good ones, Ontario and Quebec in Canada, which are also very good. It's just a great place to operate. You have all the major mining companies are within 100-mile radius of us. So you have Kinross, Anglo, Newmont, Barrick, and Agnico. All of them are within 100 miles of our project, and some of them within only 10 miles.
Yeah, it's pretty amazing. A couple of stats for the audience. So you already mentioned right there for A2 Gold, really a large and growing resource here. 1.4 million ounces of gold, 8.8 million ounces of silver, significant expansion potential, as only 18% of that has been drilled, right?
Only 18%. I mean, clearly we want to become far more aggressive now. And now that we have the capital and that the market has shifted, I think you're going to see us become far more aggressive to expand that. We have so many more targets that we have never drilled and tested along this very large property, and we have only 1.5 million ounces. I think we could significantly increase this through the drill bit.
100%. And then you mentioned this jurisdiction in Nevada, Tonopah. I was looking up. So I was out in Tonopah visiting with you to these mining exploration sites on We were there on February 27th of 2024.
Yeah, a
So
year
it's
and a half ago. Yeah.
yeah, a little bit over a year and a half since I've been out there, about 20 months. What are the biggest differences between now and when I was there?
Well, there's just far more activity. So there's when you were there, you had Kinross and you had Barrick. Anglo was just buying a position into there, but now you have Centerra. Anglo has been staking a lot of ground. Kinross has become more aggressive. And so all of these companies are now competing with the juniors in terms of acquiring land and prospective land. There's just far more activity going on there and I just got back from Tonopah today. So, I was there for this week and it's a different vibe. And the companies that are well financed are doing extremely well, and the companies that don't have capital are struggling. And that's where I see the biggest bifurcation in the junior market, right? There's companies that are not participating in this run up in gold. And then there's companies like ourselves and some other juniors that have been able to capitalize on this run because we're well financed. We have a project that has an identifiable resource. And those are the companies that have done very, very well. And then you have what I consider a little bit more riskier part of the segment, which of the exploration companies that are trying to discover gold or trying to find an economic deposit. And those have really been more struggling to get some traction.
Yeah, so I got a question for you because I want you to look at the chart here. So this is, October 2020 all the way up until February of 2024, and the price during that time moved 7.48%. Then I visit Tonopah gold mines, and since then, the price of gold is up over 100%.
That's great. I never thought about it that way.
My question is, do I need to visit Tonopah again? Because we're up 100% in 20 months since, and it didn't move at all before that.
Well, anyone who ever wants to come, more than invited to come to Tonopah. Our headquarters is based in Tonopah, actually right next to the world famous Clown Motel. And and our project is a 20-minute drive from there. One of our major project. We have other projects, but the one we spend 99% of our time is about 25-minute drive from northwest of Tonopah. So it's very easy. It's easy access. You fly into Vegas primarily, and you drive 3 hours, and you can do some sightseeing. You can go see Area 51, which is right outside the town of Beatty. So if you're a UFO person, well, you're right on the UFO highway.
Yeah, I just can't get over it. I mean, look, it's literally the 27th. It's this point on the chart.
It's crazy.
Was the day that I visited.
I never thought of the coincidence there, but it is. I don't think it's coincidental, Gav.
Pretty wild. And of course, while the gold has gone up 100% during that time, A2 Gold stock, right, from that day, I believe that y'all were trading at 10 cents the day I visited. So is that roughly 1,000% up?
Yeah, we had done a consolidation. I think that the real metric is 20. So it would have been 20 compared to where we're at today.
Okay, only 500%.
Yeah, well, yeah, but
how
it
awful.
is the number, right?
Yeah. Okay. Obviously, people listening to this can see that you're very proven in this area, many years. The manager insider ownership is at 25% right now. You have a significant portion there, right? A lot of skin in the game, successful exits. Is that kind of the goal? The goal here is basically to get acquired?
Well, I believe that exploration companies, this is just an applied A2, and now then I'll address the A2 comment, but I believe exploration companies have to have a strategy for monetizing their investment for all investors. And there's numerous paths. One of the paths is to get into production. That's a path that is, I think, very difficult. And I don't believe, my personal opinion, that exploration companies should not be their first strategy. I believe that's a different business model. I believe that exploration companies are land banks. So exploration companies, their goal is to make that asset as attractive as possible for one thing to occur. A major company or a mid-major or even a small junior that's producing takes over the company or acquires the asset or acquires the company. And I believe that there's a third thing that's recently emerged, and with more of the emergence of blockchain, and I use that loosely, but blockchains, the technology behind it, which is the tokenization of assets. And I believe that there is a strong push coming really quick in the next few years where exploration companies with assets, with identifiable resource, will be able to tokenize those assets. So now you have another avenue of monetizing your investment, and also investors have another way of participating in exploration companies. It doesn't, you don't have to buy the company, you can buy a piece of that asset. And I think that will lead to a major run on the exploration companies, which, as I've talked about, are relatively undervalued relative to the price of gold, in my opinion. And so the tokenization aspect I think will be something monumental, and that will lead to a revaluation of exploration companies on the positive side.
Perfect. Yeah, great breakdown there. And I agree with you. Everybody's got to have a plan how they're going to create shareholder value there. I love that you mentioned Kinross a couple of times. They're one of my favorite companies in the space as well. I do own stock in Kinross, so just as a disclosure there, although obviously they're not sponsoring or paying for this, but they invest in you guys. They've had a great year. They're up about 192.5%
Wild.
at the moment. So they've just continued to soar. They've moved up in the last week another almost 9%. So it must be amazing to have strategic partners like them that are backing you, correct?
They're a great company. I mean, I've been pounding the table about Kinross for 5 years. I think that they are just a well-run company, and they are a well-run company measured by how they treat their shareholders and their shareholder friendliness. And they really made a 180 degree about 7 or 8 years ago from maximizing mining operations to maximizing returns for shareholders. And since then, the company has been on a tear. And I love what they do. I think they're just a great company. It would still be my go-to company. And it has nothing to do with the conflicts I have with them, and because they're a major shareholder. I've been saying this before they even invested in A2 Gold. They are probably still the best risk to return out there.
Yeah. I was talking about it with people the other week, and they were pushing through all-time highs. They broke the 2008 highs at about 2480, and then now they're at 2740 already. So you go through those highs and you just continue to keep going. It can be quite an operation. Okay, right now also just a couple other pieces for people to be aware of who are looking into A2 Gold. Ongoing 20,000 meter drill campaign and news flow. So there's a core NRC drill program that's aimed at expanding the current 1.4 million ounce resource at Eastside with assets specs so they're going to do assessments on this. Is that correct?
Yeah. So we did a 2,000 meter core drill program, which is just ending in the next few days, and then we'll follow that up with 18,000 meters of an RC drill program, and the goal of that is to obviously come up with an updated resource estimate beyond what we have today, the 1.4 million, 9 million ounce of silver. And so there, in terms of news flows, those core samples as well as the RC samples will go into a lab, and that lab will be assayed, and those assays we will have to press release. So there is significant news flow over the next, I would say, 4 months coming at A2 Gold, starting, possibly in the next few weeks, and then that probably running for at least 4 to 5 months.
Very nice. Very nice. And then you guys are also very well financed at this point, right?
Yeah.
There's no need for dilution or anything like that.
I mean, we have no need to do it. I mean, you never know what will happen, but we don't need to do a financing.
Very nice. All right, a couple other things. First off, I've been using this, by the way. This is my new fidget spinner. It's a little bar of gold. Not real gold, but this is what I've moved into over the last couple months. It keeps gold on my mind constantly, All right. With that being said, a couple charts here to take a look at for the moment. So this one pulling up first. This is the one that's been all over social media. How do you interpret this chart?
Well, I think there's 2 reasons why those numbers or that gap is closing between reserves held in dollar versus gold. Dollar only goes up when central banks add to the reserves, and usually they add to the reserves through trade. The gold has gone up, has almost tripled, but it's been primarily a result of just the revaluation on the price. Gold, central banks have been adding to their gold holdings as on a tonnage basis. So you have two things occurring: central banks adding tonnage, and then gold prices going from 1,500 to 4,000. So clearly everything's looked at on a US dollar basis, and that's the reserve currency of the world. Henceforth, even gold gets valued at US dollars, right? So that gap is closed, I would say 80 to 90% just because of the revaluation of the gold price, and then about 20%, and I'm estimating, has been because central banks are still buying gold.
Very interesting. Yeah, I think people probably miss out on the first part, what you're saying there, which is the price of gold has gone up so much, right, while the dollar is weakening. And so it does lead to some things like this happening.
I think what's being missed here is that gold has surpassed the euro in terms of central bank reserves.
Why do you see that as largely important?
Well, because the euro was supposed to compete with the US dollars in terms of central bank reserves being held. And I think it's just a reflection that the euro and investors are looking at the EU, as a weak economy, a country, a region, and a economic bloc that, according to investors, it has a very weak outlook on their future, and aging population, weak economics, and people don't feel comfortable holding euros. So gold has replaced more than gold replacing US dollars. I think gold has replaced more euros.
Yeah, it's a good point. All right, I got another chart here. So this is the historical gold breakouts. And you can see here the 1972 breakout, right, which ran up here and then popped up really nicely. 1978, which just went absolutely vertical. 2007, which was a bit of a low, slung, drawn out. And then 2024, which right now you can see basically mapped out here from 2000 up to 4,000 at the moment. I think what's nice about this chart is that it shows that as vertical as this move has seemed, when you look at past gold breakouts, it is nowhere near the move that we've seen elsewhere. And obviously some of these happened over longer time periods, but what do you take away from this, and where do you see this going in conjunction with these other lines?
Well, I'm hopeful that the line just continues and it goes up 10-15% a year. I think what most people don't realize that from a mining perspective is that oil prices are down, and that's your second largest component in producing, in operating a mine. But going back to this chart, there's different shocks in the system. The gold chart going back to 1978 was a reflection of the U.S. exiting Vietnam and having printed money while the world was essentially on a gold standard till actually the day I was born. So I won't tell you what year that was, but you can look back. I was born that day that the U.S. removed themselves from the gold standard.
The day. Wow.
The day and year. So I was born with that destiny. I think that it's a very healthy chart, and gold is still recovering. If you go back 50 years or 60 years, gold was the number one reserve asset, right? So it's just recovering what it's lost over the last 50 years through the US dollar hegemony. And I think that's very, very healthy. I like to see this. I hadn't seen this chart. It's a very healthy. You don't want to see the 1978 blip. I don't think that's healthy. And
no.
And the 1972 one is kind of misleading, just simply because gold had been valued at $35 an ounce for, I don't remember, 50 years or 40 years, about 40 years prior to that. So another thing you don't want to see I think that's not reflective. And then the purple chart, I think, is the average. So I'm not looking at that, but I think it's very, very healthy where it's at. I'm not worried about gold. I mean, clearly there could be a correction that takes it down to their 200-day moving average, which I think would still be healthy. But gold's not going anywhere. It's very, very, it's going to be bid. And if what you talked about more, I think you said Morgan Stanley or Merrill Lynch.
Morgan Stanley, yeah.
Yeah, if you don't need 20%, at 5%, this goes almost ballistic. And if a fraction of that 5% goes into the mining and exploration, there's not enough companies. So still a relative. I think you can add all of these companies up, the producers, the miners, and it's only one half of NVIDIA, or not even that, one quarter of NVIDIA, right? So that's the entire industry, the entire one: junior, mining, production, explorers, and the major cap. I don't think would even get to one quarter of the value of NVIDIA.
Wild, very wild. But yeah, it is a great chart. I agree with you. Pretty cool fun fact there about your birth date. I guess mine kind of lines up. I was born about 20 days before Google was invented. So, maybe I was destined to be in the Google world and in the internet.
Yeah.
So I've got one last chart to look at, and then we can move into some wrap up here. This one I thought was kind of interesting. Can you see it well?
Yep.
All right. So this was there, actually. Gold bar and coin demand in tons, 2010 through 2024, and just being able to see who's buying gold. Right. And so I think this is interesting because USA and Europe are not necessarily growing into a larger component here, but really it is China that is largely buying, more in India, and really the rest of the world as well. What do you take away from something like this?
Well, I mean, for me, the biggest takeaway, and Peter Schiff could probably agree with this, is that it's the rest of the world moving away from the rest of the world moving away from the Western dominated world. And part of that has to do with how the US has kind of weaponized the financial system, whether that's against Russia or whomever. And so I think there's distrust and people just moving away and looking for other alternative investments. So I think that's going to continue. I don't think that's going to strengthen. I think you'll see continued moving away. And but I also believe that the crypto and the blockchain and tokenization is going to play a monumental role in gold and silver in the future. I'm starting to see it now, like in people, rather than having these meme coins and things that really don't have any intrinsic value backing it up. And Bitcoin's a little bit, Bitcoin's a little bit different, but I think that a lot of the next wave of tokenization crypto will involve hard assets. And I think gold and silver will be at the center of that.
Yeah, maybe we should just lean into that for just a second longer. So tokenization and gold seemingly fitting together pretty well here, especially because gold heavy, taking physical, like reception of it can be a lot for most people. Where are you going to store it? How are you going to move it? Expensive. Why tokenization versus people just, buying the stock or something like that?
Well, I think it's just another element. I don't think people are going to stop buying stocks or buying things. I think they're going to do both. And tokenization allows you to own, let's say you like a company that has multiple assets, but maybe you just don't want to take Argentina risk, right? Or you don't want to take the DRC risk. You want to take an asset in the Nevada or Ontario or wherever, Idaho, Utah, and say, I want to have a little part of that asset, and tokenization will kind of let you to do that. You weren't able to do that before, right? And I think that's going to be, I see it firsthand that is the next wave that I see becoming very, very large in this industry. But it's only another vehicle. It's not going to take away from physical gold. It's not going to take away from people buying ETFs or buying mining and exploration companies. I think it's just another tool, and it's another tool that I think is beneficial to everyone, including the exploration companies, because if you need to raise money, you can just issue more stock, or you can actually tokenize part of your assets. And I think that's just another tool for companies to be able to do it. And I think it's a major, major positive.
Absolutely. Two last things. So when we zoom out on A2 Gold, I have price history back until January of 2018. That's what I'm seeing. What's the start?
So A2 Gold, which was previously named Allegiant Gold, was spun out from a company, Columbus Gold, around that time. I think the beginning of 2018. The company had existed and had acquired most of their assets between 2010 and 14. So it's a company that had existed. I took over in 2019, September 16, 2019. And that's when I started putting kind of my stamp on it and changing things into the image that I thought an exploration company should be. And unfortunately, it was just in a very, very bad market. I'm only
Right.
catching the positive side of it recently.
Yeah, and this is, I mean, different places at different charts, and you've mentioned that there were a couple of changes as well. But just looking on Seeking Alpha for a second, which, by the way, Wall Street strong buy, 5 out of 5. Just looking here, it shows that kind of the stock was right around where it is right now, back when it spun out, and so I'm kind of looking to see if this could break all-time highs.
Yeah, I mean, when it first came out, I wasn't managing the company. When it first came out as a spin out, I believe it came out around $1.20 equivalent, roughly. And yeah, and gold was maybe 1,600, 1,500 at that time, roughly.
Yeah.
So
Shout out to Laurentian Research back in 2021.
yeah,
Early, but not incorrect. Stock too cheap to ignore.
correct.
That's cool. Okay, very interesting there. So that was just one thing that I was looking at. I always look, I'm a technical guy, so I like to look for things breaking through to new all-time highs, especially in a bull market like this. You can see a lot of opportunity, so it's always very interesting to me. But I appreciate you joining up today. I think we covered a lot. Is there anything that we didn't touch on that you think is important for people to know when it comes to this industry?
I think you need to do your due diligence. I highly recommend talking to management, especially in the smaller companies, because you really are taking management risk. At the end of the day, you're hopeful that the management is aligned with you, understands, knows what they're doing, have had a successful track record of doing things and operating in a good jurisdiction and are prudent. And the only way you can do that is by talking to people. So do your own due diligence. Never invest in anything in which you don't speak to the company. I've always believed that, especially the smaller ones.
100%. Peter, it's been a pleasure having you on the show. I think that this will be really helpful for a lot of people who are looking to get exposure to this area, but specifically to understand the difference between buying the asset directly, investing in the miners, and understanding exploration, right? And so that's kind of the big 3 areas here, different levels of risk, but certainly different levels of reward. We've really made the case, I think, for gold as a whole. So everything else kind of goes in lockstep with it. Any final comments for the show today?
No, I appreciate everyone taking the time to listen to this. And once again, thank you for your support and your time. And Gav, thanks for doing such a great job, and love what you guys are doing. So thank you. And you guys have a great week, rest of the week, and a great weekend.
Our pleasure. Thank you to everyone that tuned in today on The Wolf Show. More content to come. If you want more live content, we're going to have more trading and other items. Of course, our Power Hour analysis, and then earnings. Earnings season is here, so some good stuff coming. Also, by the way, funny comment that stood out earlier. You said I've never seen gold at 4,300 before, which I thought was funny because nobody's ever seen gold at 4,300 before. First time ever today. So Great day to do this stream. Thanks everyone again for tuning in. This will turn into a recording on YouTube, LinkedIn, and Twitter as soon as we close out, and you can restart it from the beginning.